Cracker Barrel, Old Country Stores. I watched it drop steadily from 3 years ago, about 170 to the 50s now. Now it sports a 9% dividend. They got good food, seem to have good management, and they have real estate on their balance.
I know. Let me do this. I myself have been amazed that the stock has dropped like a rock, and I've been amazed because I think they can cover that dividend. We're going to do some work on that because I used to recommend the stock, and it has been horrendous, and I haven't looked at it in many a year, so we'll come back and do that one. Kevin from Missouri, ask and you shall receive. Thank you for that great question last night. And in fact, I have done some homework about Cracker Barrel Old Country Store, the restaurant chain with a retail kicker known for its kind of off-highway locations. And here it goes. Like I said in the old days, Cracker Barrel was really one great stock. I mean, for nearly 4 decades after it came public in '81, it steadily marched higher. I used to constantly talk about it, and I used to go all the time. But then, coming to the financial crisis, it did become a mega horse, galloping from 10 and change in late 2008 to an all-time high of 185 in late 2018. It's 10 years. When the pandemic hit, though, the stock, it just got eviscerated. But by April of 2021, it was back to pre-COVID levels. This thing was like Teflon. Since then, though, Cracker Barrel's been rolling downhill. It's now $56 and change, only a few bucks above where it bottomed during lockdown in 2020. So what the heck happened here? When you dig into the numbers, it's clear Cracker Barrel came out of the pandemic as a much weaker operator. That's highly unusual. Sure, they've had some revenue growth versus 2019, but much of that's because they acquired Maple Street Biscuit Company in 2019, and that brand became the only real source of new store growth here. More important, Cracker Barrel's earnings are still nowhere near where they were in 2019 because their profitability never really recovered. See, these guys earned more than $9 per share in 2019, but this year they're only expected to make $4.59 per share, and that's down substantially from 2023, too. The cash flow trajectory is similarly subpar. So what's the problem here? First, consumers have been moving more towards quick service or limited service food places rather than full-service restaurants like Cracker Barrel. Second, their clientele skews older, and because many older people are on a fixed income, they tend to be more resistant to price hikes. While every other restaurant raised prices aggressively over the past few years, Cracker Barrel hasn't had much room to maneuver, even though they're dealing with the same cost inflation as everybody else. Third, the company's been slow to adapt to the modern era. They only introduced a loyalty program late last year. They haven't had much success appealing to younger people. And while Maple Street Biscuit can give them some growth, it's still too small to really move the needle at this point. They're kind of locked in here. Fourth, Cracker Barrel has some quirky company-specific issues. The whole restaurant industry wants to speed up the paying process in order to get people in and out faster. That's called throughput. But Cracker Barrel has those attached retail stores, the ones with like the rocking chairs. So getting you out the door faster means you're less likely to buy the stuff for the retail side where the big money is. And that's why this stock's been such a nightmare. But what do we do? What do we do with it now? Okay, first thing you need to know, the company is understanding of the problem. See, last year they just brought in a CEO. They poached her from Taco Bell, Julie Masino. And I got to tell you, she's only taken over in November. She's only been on the job for 5 months, but we're already seeing signs of improvement in the latest quarter. Cracker Barrel saw an improvement in traffic trends and better than expected same-store sales, thanks to higher spending and labor and marketing. Seems worth it. But management guided for a meaningful decline in operating income for the quarter that just ended as they continue to spend more money in order to turn things around. See, Wall Street didn't like that. Not one bit. Okay, bad forecast. They want Cracker Barrel to focus on profitability first, hence the recent weakness in the stock. But this spending is actually part of the initial turnaround plan that Messina rolled out late last year. They're spending more on labor and advertising in order to boost traffic. That said, Messina's adamant that there's still a lot of work left to do. She wants to reposition the brand, refresh the stores, bolster Cracker Barrel's marketing efforts. On top of that, she's rolling out new menu items as well as value-oriented menu available on weeknights from 4 to 6 p.m. That's aimed at the early bird special senior citizen crowd. That way they can raise prices after that early dinner wave without losing too many people. Finally, she's planning to find ways to reduce the amount of labor needed to run the stores, which would do a great deal to contain costs and get the margins expanding again. Now, on May 16th, Cracker Barrel hosts and I'm going to quote it, strategic transformation update call, where we'll hear more details on its turnaround plan. Frankly, I want to hear that plan. I got to wait. I can't talk about what I think I would do with this thing until I can't give it a full-throated endorsement until I listen to the call. I say wait because there's one big caveat here. When Kevin in Missouri called in about Cracker Barrel, he pointed out that the yield's now 9%, right? Now, that's a great return, assuming the company can pay the dividend. I said the payout's well covered. It only costs them $150 million per year, which is about half of Cracker Barrel's expected free cash flow. So, again, they can cover the dividend, but now you got to ask yourself, new CEO, do they want to pay it? See, with the new CEO in place and some expensive turnaround initiatives ahead of them, which they do have, it wouldn't shock me if Cracker Barrel decides to cut that dividend in order to free up some cash for its investments. I'd expect that to hurt the stock, but keep in mind that it's been selling off for months because people believe a dividend cut might be coming. On the other hand, if management reaffirms its commitment to the dividend, which I think would actually be surprising, well, then this stock could soar to the point where the yield gets a lot more reasonable. Again, one more reason to wait for the strategic transformation update in 2 weeks. I don't know, maybe you could buy some calls on it and risk, cut off your downside. But ultimately, here's where I come down. I want to recommend Cracker Barrel. I really do. But I'm not quite there yet. I can't get comfortable. I'm afraid of the dividend cut. The possibility of one. Yes, the company's finally come to terms with its structural issues. Yes, I'm optimistic about new CEO Julie Masino and her turnaround plan. She sounds real smart. But before I pound the table on Cracker Barrel, I got to hear what the company says in 2 weeks during the strategic transformation update call, especially on that dividend front. So here's the bottom line. Until we get more clarity on that dividend, you got to wait, okay? But there is a good chance that we'll find out what they're doing in 2 weeks and whether they cut the dividend or keep it. Then we'll make up our minds. Thank you to our callers. Kevin, you're no longer in the show me mode. You're in the do mode. Mad Money is back after the break.
Coming up, can summertime wanderlust make your favorite stocks go gangbusters? Cramer checks in on a few key names in travel. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.